We're half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with David Ingles.
Let's get to your top stories today. Stocks across the Asia Pacific are extending gains as the U.S. and China announce massive tariff cuts. Now, President Trump also saying that China's agreed to bring down trade barriers put in place after Liberation Day.
Meanwhile, bond yields rise as investors dump the safe havens, emboldened by the de-escalation in trade tensions between the world's two largest economies.
Plus, Chinese President Xi Jinping hosting leaders from Latin America with plans to sign new economic deals with Brazil, helping both countries reduce the reliance on the United States. Good morning. Welcome to the show. Just an update here really of where we are market-wise. So Asia, when you look at equity markets extending, of course, what we got overnight, although it's worth pointing out, U.S. futures already, as you can see, are down about a third of 1%. A couple of markets are coming in line, including Taiwan, where we are getting a 2.2% gain in the opening bell. It's effectively a reversal of the big moves from the afternoon session in the Asia Pacific all the way to this morning, right? So this big pop in U.S. yields. We're a little bit lower there. Asia, though, extending the melt up in yields overnight, with the Japanese 10-year, as you can see now, 146 on that. And again, a reversal of what we saw overnight, with gold futures pushing higher and dollar weakness coming through into the Asia-Pacific chasm. Very, very quickly, let's have a look at how we did overnight on the Golden Dragon Index, up as well. Volumes about 60% heavier than your 30-day average. Of course, you had some inflows coming through. You have the crane shares here, K-Web up about 5.5. Just a cross-section of some of the big moves we'll be tracking going into the open today. We also have some updates, by the way, on the CATL listing that, well, effectively drops this time next week. Nomura's out, upgrading Chinese stocks. Bottom of your screens coming through there to overweight from neutral. Interestingly, we are getting, and of course, it's worth pointing out, right? So the news flow came about a few hours before Hong Kong closed yesterday. So arguably, you get most of that getting priced in yesterday. So we are getting some weakness coming through on futures right now. A pullback a little bit on the 10-year yield. And, of course, dollar China, as you can see, 720. That narrowing, by the way, here, Yvonne, between the offshore rate and the onshore rate. Yvonne.
Yep, as you say, maybe we might not see a second day of this, but it's going to be time will tell. You take a look at what the market superlatives are. It was like a bad dream, wasn't it, right, when it comes to global stocks? Global stocks basically had the best day in a month yesterday on the back of that massive announcement on the de-escalation of that trade war. The dollar, best day in 6 months. It was more than 1% gain to the upside here in some ways. And you take a look at that. That brings us back to the days of November, when Trump actually won that U.S. election. And you mentioned about the safe havens on offer. You mentioned gold, yen, Swiss franc. Gold had the worst day in 2 weeks. And volatility is coming down. You've seen the VIX below 20 for the first time since March. Where does that leave the recession trades? It seems like we're selling those out here this morning as well. You take a look at how Fed pricing is, too. It maybe there's a sense that traders are betting that the U.S. can avoid that recession now. And you take a look at how things were looking before. We were thinking maybe about 3 rate cuts here in 2025. That was about last week. Now we're talking about maybe 2 rate cuts for 2025 from the Fed this year. In fact, and that has been pushed back to maybe September now from maybe July, just about a week ago, and that was where the expectations were. So even the September bets, Dave, are also coming down now. It's not quite 100% anymore. So there's certainly a lot at stake here. And what does that mean in this whole 90-day cooling period? Is it really leaning to risk now? President Trump did speak about this whole deal and really de-escalating of the trade war and really hailing it as a win and a total reset with China, suggesting even greater concessions could be in store if talks progress further.
So suspend and remove all of its non-monetary barriers. They've agreed to do that. Well, they're very numerous. But again, to me, the biggest thing that came out of that meeting is they've agreed. Now we have to get it papered, but they've agreed to open up China. It's going to be great for everybody.
It's obviously a floor that they are now with everyone else who did not retaliate. So the levels have come down to the pause level. And what I would say is 34, which is their assigned April 2nd level, would be a ceiling.
Right. And as we were pointing out, U.S. futures and some of the contracts here in Hong Kong and up in Singapore are also now in the red. Let's bring in Stephen Engel, our Chief North Asia correspondent, to get us up to speed. You've been covering the story why don't you start things off?
Yeah, a lot of numbers to go through.
Yeah.
Obviously, they had gone up to 145%. Even Donald Trump said it couldn't go any higher. Essentially, because China also, reciprocated with 125%, that pretty much grinding a lot of the trade across the Pacific to a halt. So what's happened after these 2 days in Switzerland, the talks, those 145 are down to 30. Now, that 30% includes the 20% of the fentanyl issue, right? So that there's still room to negotiate potentially on the fentanyl issue. Without the fentanyl issue of 20%, it brings it down to 10%, which is pretty much in line with other trading partners that they've negotiated down, as Scott Bessent just talked about.
Yeah.
That is the floor. He talks about that ceiling of April 2nd, 34% is probably, something that they won't go beyond. Considerably better than we were 72 hours ago, obviously, and that's why we're seeing the celebratory mood on the markets. And again, where do we go from here? Further talks, no doubt. Is this a reprieve or is this a total reset, as Donald Trump has talked about on Saturday or last Friday? That's what we have to kind of go from here. But it's obviously being cheered in China, and all those exporters who now don't necessarily have to fire their employees, shut down factories, they can start receiving orders again. You could see a big boost in those 90 days of shipping across the Pacific if this is going to be another front-loading event.
I mean, most people that we talk to are quite surprised at how quickly we reached some sort of consensus here. It begs the question, who blinked first?
Yeah, right. Well, you're going to see pundits say who won and who didn't lose. But if you look at China, they had three main demands going into this. Low expectations, but three main demands. They wanted a cut in those tariffs, and they did not necessarily want to come to the bargaining table until those tariffs were cut. They wanted mutual respect, and He Lifeng, who led the delegation of the Chinese vice premier, did talk about how he was impressed by the professionalism of the U.S. delegation in Switzerland, and they wanted that point person on trade. They got the point person. Scott Bessent going forward will be the point man, because they like to have who are we talking to in Washington, right? Is it Scott Bessent, or is it through the media, through Donald Trump or Congress, which they don't necessarily know how to navigate the political gyrations there coming from Washington. Jamison Greer, the U.S. trade representative, essentially summed it up when he said, how did you come up with this new number for China, 30%, when there was lots of debate that Donald Trump said maybe 80% would be a good number. Sources telling Bloomberg on Friday that they might start the negotiation at 60%. They came down to 30, 20 of which, as I said, is on the fentanyl issue. Jamison Greer said everything is a negotiation, and he called the trade talks outcome over the weekend pragmatic.
All right, Steve, our Chief North Asia correspondent, Stephen Ingles there on the latest. And for more, we're so pleased to have Gina Martin-Adams here in the region, our Chief Equity Strategist for Bloomberg Intelligence. Perfect timing, really, on the back of this risk rally that we're seeing. Is that Buy America trade back in play now?
It does appear to be as of yesterday. I think that we've actually seen U.S. stocks as the very high beta play in the global equity markets really all year. The worst performer on the downside, one of the better performers on the upside. So this is consistent with behavior that has been in play for 2025. When the markets rally, U.S. tends to be in a leadership position. When they fall, U.S. tends to fall the worst. That's not necessarily a great sign for what to expect. It just means volatility is going to continue to prevail. I do think that in large part we did see a bit of relief, though. At least the greatest downside extremes are getting taken out of the market. Now it becomes a question, though, of how much upside really remains in an environment where we're still going to have to price for a slower earnings growth landscape as a result of likely tariffs of any description. We probably still have limited upside to the S&P 500, to the broader U.S. market. Remember, 30% tariff on Chinese goods is likely going to be paid by U.S. companies who are importing those goods, at least to some degree. That's a depletion in profitability trends for U.S. companies. That's not likely priced terribly accurately in a market where U.S. stocks are commanding a premium of 30, 40, 50% in some cases to the rest of the world. So it's a messy market in 2025 is the way that we've been describing it, a volatile market, probably some degree of loss of U.S. leadership overall as some of the rest of the world comes out of this in better condition than the U.S. corporates. But a lot remains to be seen. Plenty of other policy metrics to follow. We've got the tax bill now going through Congress.
Yeah.
We've got a ton of uncertainty still with respect to trade, with this just being yet another pause. So you can expect a large amount of frustrated investors as the likely outcome of 2025, frankly.
Maybe less, to your point, the tail risk has somewhat been removed. But again, the question around upside, right? So talk to us about the big picture here, because last week you guys put out this equity regime, this change in your model. After 21 months, it's now shifted red. What's changed, if any, and what does that really tell us?
This is a great, I think it's a great sort of context. Is we have two different regime models, and those are models that give us a sense of what to expect longer term. What's the climate for equity investing? The one we produced last week is our market regime model, which really looks at several different indicators like M2, like breadth in the market, like volatility overall, earnings trends, and the like. And it says, okay, the best of the best times are in the past. You can expect slower returns going forward. Not necessarily horrible returns. We're not talking about an expectation for another 20% decline. But on average, when we're in a red regime, such as the one we're in, we have very, very low single-digit returns over the next 6 months or so, on average. Very consistent with that is the economic regime. The economic regime model is something that we released earlier this week. That gives us a sense of the current moving parts in the economy and what they imply for the broad equity market returns. Unfortunately, we're in a point in time where the economy is deteriorating and yet not falling fully into recession. So we haven't yet reached major momentum lows in the economy. That also is historically sets a precedent for very low average annualized returns for the equity market, at least in the short run. So our broader models are saying, okay, look, you had a great experience the last 2 years. We were either in the yellow on the regime model or suggesting from our economic regime model, very robust returns were likely. Things changed in 2025. We hit momentum peaks in 2024, even without the trade risk that has emerged this year.
That's it.
And that set us a precedent for a rockier climate for stocks in 2025. And I think that trade only exacerbates that issue.
You mentioned we were in the yellow regime for maybe 21 months or so. How long can we stay in this red regime then?
Yeah, well, it depends upon the indicators. So, for instance, M2 growth is one of the indicators that we follow. If the Fed does start to ease policy, creating much stronger M2 growth over the long term, that can create a trigger. If you get better breadth conditions emerging on the equity market, that too can trigger the model to improve somewhat. If you get earnings estimate revisions in the positive, some earnings momentum recovery off of lows presumably occurring this year, that can help. So we watch the indicators pretty carefully. We are very cautious not to make forecasts, only to look at what's happening in the market to derive our expectations.
Yep, here's how the currents are directed. Fantastic. Gina Martin-Adams, fantastic timing as well. Perfect timing, in fact, given the market 24 hours that we've had this window. Bloomberg Intelligence Chief Equity Strategist. In fact, just on a very note here, our folks at MLive have put out this question of the day. Chime in. So we're about 5% away. How quickly do we get back to the top, if at all? Chime in on that for our Bloomberg clients. Right, going into the open today, Shanghai, Shenzhen, and here in Hong Kong, 17 minutes away. Futures are pointing down. It's a beautiful spring day, though, here in Hong Kong. Don't take anything away from that. There we go. Good morning. This is the China Show. Good morning. What a change, what a difference 24 hours makes, right? Bottom of your screens, I think this is the first fixing below the 720 handle in some time. This time yesterday, we were speaking with Lee Dao-Kui, who actually told us effectively what to expect as far as the trade deal goes.
He called it.
He called it, yeah, 30%.
Thanks, Dao-Kui.
So, among many other things that he pointed out. There we go, on the Chinese currency. Stronger, as you can see, because of the fix coming through. Might that actually provide an anchor for risk assets, given that we've seen Chinese equity futures start the day in the red? And I would imagine you get a stronger fix, that tends to be a tailwind for risk assets here.
Yep, so certainly that's going to be one to watch as well. Let's get the take from Eurasia Group and Wang, China Director. She joins us now from Singapore with the latest. Obviously, everyone's been talking about how swift this sort of deal has come into play. Obviously, there was a 90-day cooling period. But, essentially, who won in this whole battle?
Well, it does look like on the surface everybody wins. China's export sector finally caught a break, especially for small producers. And for the U.S., it looks like Trump has a temporary win because now he can say that he has successfully contained China and there can be a better deal with China. But we have to keep in mind that the bilateral relationship hasn't changed. China is still the same China. U.S. is still the same U.S. There's no fundamental trust between the two parties. Right now, we're looking at this temporary truce rather than a permanent peace.
Yeah, so I think two concepts came out yesterday. Total reset, number one. Strategic decoupling, second concept. What does that mean and how does that look?
Actually, when we look at Trump's tariff policy towards China, at this point, it's safe to say that it has backfired because trade decoupling is unlikely, at least in the short term, between U.S. and China. So there is a total reset on how Trump is going to treat China's export, but it doesn't mean his tariff policy has a reversal. So after this 90-day truce, it is unlikely that we'll still see this low level of tariffs. It will very likely still go back to the 40 to 65% range. And when that happens, there has to be a lot of more compromises coming from China. There are still deals that can be talked about, but China has to make bigger concessions than what we see now.
Yeah, Dan, I was going to ask you, there's one thing that China agreed to was removing those non-tariff barriers to U.S. imports. They didn't give too much details on what that might be, but what are your guesses here? Is it the 7 rare earths that were on that sort of export control list that might be at play here?
Definitely. The rare earth exports will be a critical part of it, and also the access to Chinese market for both goods producers and services providers. So this is something that the U.S. has been wanting for a long time. And on the China side, this concession is relatively easy to make to allow more of an American company presence in China. Actually, we have already heard there is some less of scrutiny over American companies' operation in China. So this is also good news for Americans' investment.
I don't know how to phrase it. What assumptions can we make? Really, nobody knows. What assumptions can we make what happens after 90 days? In other words, what should companies do? What should investors do with this 90-day sort of window? Do we see a front loading of exports? Do we see a front loading of tactical trades? Just give us a sense of how you're thinking about this 90-day window. What happens after that?
Well, the 90-day window is very short in trade diplomacy. So for this kind of trade talk, it can easily last for years or even decades. So right now, people do have this break. So the export in the next 3 months for China would be stellar performance. But after that, things have to go back to the fundamentals. So the companies in China do not have illusions that in the future they could just export as usual. The transshipment through third countries will still be a key element for a lot of their decision making. And in the future, we will see not just Chinese exports to other countries, but also the export of the factors of production. Like Chinese people, there will be more of them going abroad, more of Chinese capital investment in overseas market, and also more Chinese technology being overseas. So this is actually a reallocation of Chinese production capacity across the board, and it's not just the current trade situation.
And Dan, as we've talked about, China was the only nation that did, in fact, retaliate against these tariffs against the U.S. and did give reciprocal tariffs. In what way do you think China's defiance in this trade war paid off in some ways? Would you say this was the best outcome for Beijing?
I think this is a welcoming change for Beijing, but I wouldn't say this is the best outcome. The best outcome would be that people believe the tariffs are finally rolled back and the trade system in this world is still favoring China. But what is believed now is the bilateral relationship between China and the U.S. is still beyond salvation. And we do not see any changes in the fundamental relationship. So the development model is different. China is still favoring the industrial policies with state subsidy. So in the end, it is this long-term competition between China and the US, especially in the transformative technologies. So I don't think that China will do anything drastically different. Now, both countries will try very hard to talk to their trading partners in order to gain more leverage in their future trade talks. But besides that, I just do not see any of those fundamental positive changes.
Can we at least, and I'll try to end on a positive note, I'll try to see if you can end on a positive note here. Can we at least assume that the tail risks have gone away?
It's possible. And actually, I think for Trump, he has been squandering so much political capital on just tariffs against China. Now for him, there's also a shift in his priority. Since in his economic agenda, actually there are three pillars. There's the tax cut, there's the deregulation, there's the tariffs. So far, he only got the time to do tariffs. So in the next number of months, he probably shift his attention to those other economic agenda that he has. And going against China is something he will still focus on, but with less attention. And for China, in the next few months, probably the job market situation would improve slightly, because we recently completed this study. At least 3 to 5 million jobs will be affected just due to this Trump tariff from April. So now, with the job market stabilization, China can also think of probably a less drastic way against the U.S. sanction.
Wang, thank you so much. Fantastic insights. China Director at Eurasia Group in Singapore for us. Right, so we did get the fixing out of the PBOC about 8 minutes back, just to correct myself. And a reminder, sometimes I say to my significant other who thinks I'm perfect, sometimes we slip in these mistakes every now and then, just to underscore the fact that no one is perfect.
We're only
human.
You're also human too, Dave.
In 5 weeks. There we go. We said 5 years. Anyway, there we go. Below 720 for the first time since April 7th.
But then again, they're allowing for a stronger currency in light of this whole truce. Temporary one, albeit, but certainly. There you go. Pre-market in Hong Kong. And we're seeing a little bit of negativity here. Perhaps a lot of this optimism has been already priced in from yesterday. On the back of that announcement here, we got plenty more ahead. This is Bloomberg.
All right, how quickly that went away. So futures are now down a fifth to 1%, and we're going into the Tuesday session again, also with futures on Chinese markets also pointing to some downside, 4/10 to 1%. Some bright spots though elsewhere in the region here.
Yep, your pre-market is looking like this. As we say, we are coming off a little bit on the downside here this morning. Interesting, we'll flesh out that whole Nomura note about how they're turning more tactically overweight when it comes to Chinese stocks and moving away from that neutral position and where they're going to see the opportunities. But certainly, that is what to watch here. You're watching the China Show. The Open is next. Welcome back. You're watching the China Show. We're counting down the open of markets. And yeah, it looks like that optimism over this dramatic de-escalation of tariffs between U.S. and China, that seems to be coming off a little bit now this morning. As we see and count down to this open, futures are lower. We are seeing a stronger currency, and we are below that 720 level for the renminbi here this morning. Keep in mind, that was one of the strongest fixings from the PBOC in 5 weeks or so. So perhaps they're giving a little bit of leeway for the currency to strengthen in light of the good news here of some sort of temporary truce in that trade deal. You take a look when it comes to the Hang Seng, though, we are seeing some downside here. We'll flesh out that Nomura call, right? Upgrading Chinese stocks to overweight after this truce that they've seen, saying that a significant positive for equities overall. You pair that with the geopolitical risk premium that's been taken off now. You add more of the policy support. That's a good combination, basically.
And the Goldman call yesterday, too.
Yeah.
On 7 on the currency.
So they're trimming their overweight on India for Nomura and higher allocation to China's stocks in light of all this as well. Here's what the open is looking like here. Actually seeing some decent upside on onshore. We're up about 0.5%. Shenzhen's doing a little bit better here as well. We're watching, of course, what happens with some of these tech shares. But you're seeing yields Yields slightly lower here this morning. But yeah, we're watching. Seems like things are looking pretty good. Copper, though, is taking a little bit of back seat. But most of the commodity complex, take a look at iron ore and Dalian, that's up 1.5%. Shanghai crude is also doing quite well. CATL, we can continue to get more details of what this listing in Hong Kong is going to look like here. But we are seeing some downside, well, unchanged now for that portion. But yeah, the retail portion, 21 times oversubscribed so far, according to Hong Kong reports there. You take a look at what the Hong Kong dashboard is looking like here right now. Obviously, we talk about earnings, so that's still something that's on plate, on tap here this morning as well. There you go. HS Tech seems to be the dragger here. We're down about 1.25%, and the Hang Seng is down to around 23,300 and change or so. So most sectors, it looks like, are in the red here. You take a look at how the tech shares are doing. Yes, we're coming off of some of the initial optimism now. So Tencent, Alibaba, Baidu are all lower this morning. And what you're watching out for is gold, obviously. So gold is had one of the worst days in two weeks or so.
Yep.
So certainly that's one to watch, right? The safe havens are definitely coming off. And you see that gold futures are recovering a little bit in the Asia session. But here you go. Shandong, Zhongjing, Zijing Mining, all lower this morning.
Yeah. Okay. What's the key takeaway now that markets have largely digested this? We had about an hour or so before the Hong Kong close yesterday since that news broke, and then you had a market rally overnight. The markets that were shut, it's worth pointing out, that were shut when those news lines broke in the afternoon of Asia yesterday, are playing some catch up. But then again, the red we're seeing across these screens is perhaps indicative of how far, or lack of it, how long this runway really is for risk assets. Anyway, let's talk about this and what this means really particularly between the onshore and offshore sort of dynamic between equity markets here in Greater China. Let's bring in Sang-Mi Cha, our Asia equities reporter, to talk us through this agreement between the two big economies. Might this provide a floor to the stock?
Yeah, so the CSI 300 actually had just one down session last week. So it seems like the onshore stocks are getting a little bit of that boost. Yeah. And when we look back, we see that between April 24th and May 8th, we've seen about $2.2 billion were snapped up by the overseas investors. So foreigners are owning about 3 trillion yuan in Shanghai and Shenzhen exchanges. And we are talking about 3.5% market cap for both of the bourses. So it means that, now that the deal is here and the overhang is removed, it seems like we'll be seeing more of that inflows into northbound. Yeah.
Okay. Tell us a little more about the southbound side of things. Chinese shares listed in Hong Kong. How are they going to fare?
Yeah, so it seems like the risk-on move does suggest that the investors are positively reacting. They have been tempted to retreat from these risk assets, and it seems like it's coming back. But we have to take a look at the southbound flows. The onshore investors were the key buyers of these Hang Seng or HSCEI shares, and they were snapping up a lot of those shares and buying the dip. But in fact, now they are actually taking profit, right? So they don't know what's going to happen. 90 days reprieve is great news, but again, they don't know it's going to stand. So they're taking profit. We've seen about $2.4 billion that was dumped yesterday. So that was actually the largest amount in 4 years. And so that goes back to the question, is this going to be a trend? Are we going to see, because that's quite a large number, quite a large amount of investors from onshore investors that are driving the Hong Kong shares.
Talk to us about earnings. We have a few on deck today.
Yes, I can talk about JD.com. It rallied a lot. Its ADR rallied a lot in the U.S. On the back of the good news. Golden Dragon Index also rallied like 5.4%, but it's dropping today. What's going to be key focus is going to be its profitability. Back in February, the company jumped into the food delivery service, and it's just burning cash, with these customer discounts going up against the sector leader, Meituan. And so now we are seeing in options trades, we're expecting about 7% moves in either direction. So that is quite sizable compared to the last 8 quarters, where it's hovered around 3.4%, 4.2%. So there's going to be a lot of moves there. And given that the margin cost for JD.com is at 3.4%, which is a bit weaker than its peers, which has even enjoyed double-digit levels, we will have to watch what happens for JD.
All right, Sang-Mi, thank you. Sang-Mi Cha there, our Asia equities reporter. Let's bring in Yuejue now, multi-asset solutions investment specialist at JPMorgan Asset Management. You take a look at some of these markets, and it's almost like Liberation Day never happened. Yuejue, what do I do now? I mean, it seems like there's not very much dip to buy.
Well, I think market response yesterday was certainly very positive. And if we look at where the markets are, it's actually higher than prior to the Liberation Day. So our view is, yes, it's definitely a very positive surprise to everybody, but we should also think about the question about what's next. Right? I think there are a couple of things that we're thinking about. And number one, 90 days is not a long period of time, and it's probably not sufficient to actually get down to the detailed agreement. So there are still a lot of uncertainties around the actual progress of the negotiation. And two, if we look at, I think where the tariff rates have traveling since Liberation Day or since the escalation point, it actually has been unidirectionally downward. And I think from this point going forward, then the question becomes, is this continue, i.e. the rate will continue to come down, or is it the point of time where it's the peak of the lowering, meaning that the rate can potentially go back on? And I think the administration, at the end of the day, is very much data-driven, right? They will look at Q2 GDP data. If the data really holds up well, there could potentially introduce new sectoral tariff into the picture. And we know that a number of strategic industries are still exempt from the tariff. Pharmaceutical will be a key area to watch out. So our view is, I think, in a more, optimistic picture, we're still talking about, the effective rates end up at around 16 to 17%, which is still a lot higher than, where we started from 2.3%. So that 2.6%. So that's a big, jump. And that would have implications in terms of lower growth and higher inflation.
And I know you guys are neutral equity still. So within equities, what's the strategy, and where does one look for value right now? Where is value?
I think valuation is certainly not cheap. I would say rich. Right? And I think to some extent investors are very much embracing the good news. So we at this point of time, we don't think it's a good time to actually add a lot of risk to equity. But within equity markets, we do see some opportunities in terms of some of the relative value in the places. We have been positive and are still have some small position on long Hong Kong equity, through that to play the China theme. And we do think that from a valuation perspective, it's still relatively more reasonable. And with the AI story, there's still a bit of gap for them to catch up. So Hong Kong is one place, and Japan equity is the other place that we think, one, it's still very much domestic market compared to some of the other markets, and the virtuous kind of trends of wages and inflation, it's still intact. So Japan is the other place that we are currently in favor.
I see, bond yields are ticking up higher now. The dollar's coming back in a big way in some ways. I mean, is it time to kind of take off some of these recession trades at least? Do we know enough at least to do that?
Yeah. We actually, have been kind of moderated our long duration bet, and precisely because I think over shorter term, we think that the catalyst for rates to actually, come down is actually, not really there. But over longer term, we do think that, given the medium-term trend where, again, weakened growth is still there. We still have a more constructive view on duration over medium term. But I think if we look at, different regions, we're seeing more of opportunities in markets like Europe, Australia, where, it's still in a inflationary environment. And the central banks actually have capability to actually, cut rates. Yes, US dollar has goes up. And we think over shorter term, that's probably the trend. But over medium term, the administration is very clear. They don't want to see a strengthening dollar. And the valuation is really expensive over longer term. So I think over medium to longer term, we'll still see dollar to come up.
There was a slight widening in credit spreads recently because of the sort of market episode. And it seems, I think to your point, the the Trump White House is very data dependent. And it seems when we approach worst case scenarios, whether markets or the data, they start pulling back, it seems. Can we make the same assumption that U.S. credit, for example, will remain resilient?
Yeah. So actually, credit is the place that we feel more constructive in. I think when we talk about, from a valuation perspective, spreads is certainly not cheap as well. But I guess when we look at the macro environment with the good news, the recession risk is definitely coming down, and that's really a positive for credit. And when we look at corporate fundamentals, the coverage ratio, as well as the default rate, that's still at a very healthy level. So all in yield, from a total return perspective, we actually think credit is still the place to be.
How far do you go down that spectrum then in terms of risk? Do I look at more high yield? How are they? How exposed to that are they to maybe the tariff impact too?
Yeah, we're actually slightly more positive in high yield versus IG, precisely because if you look at the sector mix within high yield, there are more domestic exposed versus IG that's more international exposed.
So I think back to this 90-day, let's call it a parameter. What other things can we formulate based on 90 days, or is it look like a black hole after 90 days from now?
I think, macro data is definitely an area that we need to keep watching, both from the U.S. but also China, because ultimately that's essentially the incentive for, the both sides to actually find a middle point that they can agree upon. But also, I think for investors, we need to be aware of the timeline, right? Getting into summertime, June, July, there are a number of key events to watch out. The 90 days is one, and also, we're talking about, the fiscal policy front, the tax cuts, like all these discussions may potentially trigger more of a volatility in the market. So it's not going to be a smooth ride. So definitely kind of keep close eye on all these.
Yuejue, fantastic. Thank you so much for joining us today here on SETS, Multi-Asset Solutions Investment Specialist at JPMorgan Asset Management. Right, I'm just looking at these markets. Hang Seng Index is down about 1%, split a difference. It's about 1% on the benchmarks. We're doing slightly better, although we are coming off highs a little bit as well there on the onshore benchmarks. Plenty more ahead. This is the China Show. Right, welcome back. U.S. futures are down, and as you can see, just about across the board, following a really, really good day in equity markets. Although I think it's worth pointing out the cash markets did very well. Underneath the hood, though, things like turnover and volumes were not exactly screaming the same sort of sigma and superlatives that we had in the cash market and the price itself. So I guess that is, indicative of this somewhat limited reset in markets. But yeah, I mean, speaking of certainly context, and the timeline is extremely important at this point in time, where you have the U.S. Treasury Secretary, of course, Scott Bessent, says that the reciprocal tariffs on China should not go below 10% or above 34% set by President Trump on his so-called Liberation Day about going on 6 weeks now. He also told us more about Washington's broader strategy when it comes to trade with China.
Neither side wants a generalized decoupling. The U.S. is going to do a strategic decoupling in terms of the items that we discovered during COVID were of national security interest, whether it's semiconductors, medicine, steel. So we still have generalized tariffs on some of those, but both sides agreed we do not want a generalized decoupling.
These things take time, as you know, sir. We've got 90 days now to work with. Last time around, it took 18 months to reach an agreement on purchase agreements. I think you yourself have said in the past that it can take 2 to 3 years to have a full comprehensive trade agreement with the country between the US and China. What do you think is achievable, sir, over the next 90 days?
Well, Jonathan, we're going to see, but what has to happen is it has to be fair for the American people. But in January 2020, President Trump produced a template. We had an excellent trade agreement with China, and the Biden administration chose not to enforce it. The Chinese delegation basically told us that once President Biden came into office, they just ignored their obligations. So, we already have a large framework. The other thing to remember here, Jonathan, is that this is a pause down to 10%. The April 2nd level for China is 34%. So we will be working to see where their final reciprocal number ends up. And the negotiations are a combination of tariffs, non-tariff trade barriers, currency manipulation, and subsidies of labor and capital.
Just to build on that, as I listen to you, do you consider the new levels as a ceiling or a floor?
Well, it's obviously a floor that they are now with everyone else who did not retaliate. So the levels have come down to the pause level. And what I would say is 34, which is their assigned April 2nd level, would be a ceiling, which is what I went out and told people on April 2nd, which is why I was surprised market participants panicked, because we had capped the upside for every country, and if they didn't retaliate. So this unfortunate turn of events happened because of retaliation, but now we have a process in place to avoid escalation like that again.
Secretary Bessent, just to build on that, are you saying that tariff rates will only go up from here if this really is a floor of 10% on the Chinese side and 30% on the U.S. side?
I'm not saying that they're going to go up, but it would be implausible that they would go below 10.
U.S. Treasury Secretary Scott Bessent there speaking with Bloomberg's Jonathan Ferro and Lisa Abramowitz. Now, some of the geopolitical stories that we're tracking for you this morning. Brazil and China are set to sign new trade-related agreements in Beijing on Tuesday. Both countries are looking to expand their markets to counter President Trump's protectionist threats. The deals will mark the latest step in President Lula da Silva's efforts to transform Brazil's commodities-heavy economy with Chinese assistance. Indian Prime Minister Narendra Modi says his government will not hesitate to use force to neutralize what he calls terrorist camps in Pakistan. In his first public comments after last week's strikes on Pakistan, Modi called the use of force against such targets a, quote, new normal. Tensions escalated last month after gunmen killed 26 civilians in Kashmir, leading to tit-for-tat military strikes. We got plenty more ahead. This is Bloomberg.
Right, welcome back. So earnings are coming through today. JD.com, JD Logistics. You have Tencent Music and also Samsonite on your screens right now. And, this is really, I think, broadly in line with the declines we're seeing across the region. Although options pricing, as our Asia Equities reporter Sam Lee-Chop pointing out as well, there is some large swings priced on JD.com today. Plus minus 7% this quarter compared to about a 4% in the previous quarter.
Yeah, I think they're making some inroads in this competition with Meituan, but then again, at what cost, right? They've been burning cash when it comes to throwing a lot of these customer discounts and subsidies. So certainly a lot of questions on how sustainable this is going to be, the strategy, and how aggressive can they be moving forward. Shares down about 1%. Ahead of those results. Your dashboard is looking like this in China. As we talked about here, the optimism has sort of been a little bit sapped up here this morning. In fact, the Hang Seng is now extending those losses. We're seeing declines of more than 1% here. MSCI China also down about 0.8%. Onshore, though, still holding relatively steady here, mind you. But HS Tech seems to be where that downside is. We're more than 1.5% down this morning. And yields slightly ticking lower. But yes, strengthen the currency at least. We're talking about a 7.18 handle now for dollar China.
Which is the strongest fix since April 7, and dollar China is now at the strongest level since, I think, U.S. elections, in fact. I just to underscore I think the broad watertight and goes to the point of Goldman Sachs yesterday. They think it's a 7 handle, and that it goes into the Nomura equity call overweight China is what they're looking at going into that. So I think in terms of those two things, the upward momentum in Chinese stocks is just worth pointing out as well, right? Because it did seem for a brief, let's call it 2-3 weeks, that momentum was really going away. And I think when you look at how things have shaped up right now here to my right, RSI, MSCI China, Hang Seng Index, Hang Seng China rather, and Hang Seng Tech, that still seems roughly intact. The cyclical move out, out of the U.S. into markets like Europe, Japan, and also including China. I think Gina Martin-Adams, who joined us earlier on, said tail risks might have gone away for the U.S. market, but upside potential is still in question.
Yeah, I mean, given the fact that we've swung back into a bull market for the NASDAQ already, just goes to show there really isn't much more further upside in some ways, right? It's hard to buy these dips at these levels here already. We're going to have a lot more in the way in the next hour, obviously talking a little bit more about this sort of dramatic de-escalation, the trade war. What does it mean for U.S. and China specifically in the eco front as well? We're going to have Bloomberg Economics joining us to talk more things that. And of course, watching very closely the midterm elections in the Philippines as well.
Yeah, quite a big swing there in favor or away from sort of Marcos' camp and also some candidates from the previous administration. So I think we're looking at equity markets in the Philippines up as well. Yeah, lots more on the way here on the China show. And yeah, stay tuned for that. We're down 1% in the first 25 minutes of the session.
Welcome back to the China Show. Here's a look at the HSI half hour into the session. Perhaps, it is the one market, I guess, that already reacted to this massive de-escalation of tariffs and this trade truce between the U.S. and China. So that's why we are seeing some downside of more than 1%. In fact, we're still in those session lows now for 8 shares as well as Hang Seng. But the rest of the region still looking pretty decent.
Yeah, the markets that were shut when the headlines broke are the ones playing some catch-up today. And I think it's worth pointing out, as Yvonne is pointing out, right? So Hang Seng Index is now down 1.2. I'm looking at the 2-day chart. So we're now back to 23.2, which effectively puts the index at about 10 minutes into the afternoon rally yesterday. So we've almost given up, in fact, most of the gains from that briefing out of Europe, of course, out of Scott Bessent and company there. Right, now on that very note here, I think some of the updates for today as far as markets go is the PBOC leaning into some of the strength coming through here in the U.S. dollar. Perhaps you could think about it that way, with the strongest fixing coming through in 5 weeks. First one below 720. This is the fix coming up on your screens, and that's really leading to strength in the Chinese currency against just about all, not nearly all, of its peers. So at least the majors, right? So you're looking at some strength in downside in euro, yuan, the Aussie cross, cable cross as well. Well, the pound cross as well coming up on your screens very shortly. What does it mean, I guess, in terms of the upside potential? And I think we'll get more into this, right? So it's a 90-day window. Are we about to get the mother of all front loading as far as exports go? Because we don't know how things will look in 90 days, right? Everything from Christmas goods and Christmas orders and everything in between. And certainly that was a narrative early on.
And does that swell this trade surplus that China already has with the U.S., and then it kind of backfires in some way, and maybe Trump might not like that, right? Certainly that is something that we need to deal with the next 90 days. But yes, as you mentioned, this strength into the currency, the renminbi, is helping the likes of the Korean won, the Thai baht here this morning. And yes, you are seeing, for the most part, equities in Asia doing quite well. U.S. futures, though, we are seeing some downside here this morning. But yeah, Aussie yields continue to perk up, just following that move that we saw in treasuries. Gold is also taking a bad seat here today. But yes, Euro also, I think, had one of the worst sessions yesterday, but now we're recovering just a little bit. Let's bring in our Chief North Asia correspondent, Stephen Ingles, joining us now. How should we look at this, right? I mean, obviously it's a truce, but we still got a 90-day cooling off period.
Yeah, there's so many elements to this. There's obviously, what China wanted going into these talks over the weekend in Switzerland, and that was a removal of the tariffs. And essentially, the United States has. You still have that 20%. Of that 30, they've reduced it, by the way, if you're just tuning in. From 145, the U.S. has reduced 145 down to 30. 20 of that includes the fentanyl issue, which one would assume if China makes certain pledges on fentanyl that maybe there's room for negotiation. Jamieson Greer, the U.S. trade representative, even said, how did you come up with this number of 30 from 145? Because Donald Trump talked about 80 is a good number heading into these talks. And we had heard that perhaps the United States, through sources familiar with the preparation of the U.S. Delegation to these talks with China over the weekend, that maybe 60 would be the starting point. They settled on 30. So again, Jameson Greer said everything is a negotiation. And so they negotiated down 90-day cooling off period, or reprieve, if you will, could be extended or it could go back. That's essentially where the state of play is right now. But 20 of those 30 is the fentanyl issue, so that brings it down to 10, essentially, on par with the other trading partners, including the UK that negotiated a trade deal, right? So that's what Scott Bessent said. 10 is probably the floor. Possibly 34 would be the ceiling. That is that April 2nd reciprocal tariff number on top of everything else that they've added. So that's one major part of this. The other one is Donald Trump talking about China has agreed to remove those non-tariff barriers. That's a myriad of different tools that China has used, essentially export restrictions, regulations, ownership rules. We don't have the actual specifics of which barriers China is going to remove that would allow more access to China. That's been a long-standing desire and demand of the United States.
I saw you nodding earlier on when we talked about possibly seeing a front-loading again of a lot of exports coming.
Well, we saw that obviously before Liberation Day, also before Donald Trump took the presidency in January. You saw front-loading of orders to beat whatever kind of protectionist measures might come out of the White House, and that might be the same here. We've had economists say, watch for the mother of all orders of shipping across the Pacific.
That's right.
Right, and keep in mind, this also takes effect, the reduction in the tariffs takes effect tomorrow, May 14th. If there's any ships going across the Pacific, you might want to hold off, at the port of call in Los Angeles until tomorrow, right? Because the tariffs are going to be coming down. But I think you can probably bet that over the next week or so, you're going to get a surge of orders. You mentioned Christmas. So places in like Yiwu and all these different places across China that had been counting on the Christmas orders. You got to get those in advance by about April or May for the next Christmas. So absolutely, you're seeing in Zhejiang, in Jiangsu, in Guangdong, in these coastal provinces which rely on exports, a lot of these factories which had been faced with the prospect of either closing down, canceling all shipments, unable to pick up the phone because no one was calling them for orders, also firing people. You're seeing reassessment right now, at least for the next 90 days. It's a reprieve for them.
Yeah, in fact, just on the very note that Steve was just pointing out there, just to emphasize that even further, we did speak with Dan Wang earlier on from Eurasia. This is what she had to say about what to expect over the next few weeks or so.
The 90-day window is very short in trade diplomacy. So for this kind of trade talk, it can easily last for years or even decades. So right now, people do have this break, so the export in the next 3 months for China would be stellar performance. But after that, things have to go back to the fundamentals.
Right. I think taking place right now against the backdrop of that is President Lula, of course, he's in Beijing right now, and we understand that I think we could be looking at some live pictures, in fact, of that conference.
President Xi
is about to speak right now. But give us some context here, Steve, in terms of the other trade fronts and trade relationships here.
A lot of economists are talking about winners and losers of this weekend, right? Obviously, with those tariffs coming down to levels that are probably manageable by China right now, it's significantly lower than 145. So Xi Jinping taking a harder line and playing the long game helps them, obviously, on the U.S. front, but also it buys them more time to play that long game with other partners around the world. They are diversifying where they can sell and where they can buy from, including Brazil. They've been buying more soybeans, in particular, from Brazil, to the detriment of U.S. farmers in the Midwest. And again, Lula is there yesterday and today. He's signing deals, trade deals with the Chinese. Two-way trade between Brazil and China is larger than Brazil to the United States. So Lula yesterday said China needs Brazil and Brazil needs China, full stop. You're also seeing, I believe, a Colombian delegation. I'm not sure if the Colombian president is there in China as well, but we'll be signing what we hear, perhaps, acceding to the Belt and Road Initiative, which would be a big political and economic win for Beijing.
Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent there. And, of course, that summit is underway, as you can see there, as you did see on your screens in mainland China right now. Right, Hang Seng Index 2-day chart, just some context, really, of how far we went up into the close and how far, so far, we've come down and retraced our steps. Not completely all the way, but almost halfway back, as you can see. And that massive, almost vertical spike you see was when the headlines hit out of the briefing in Europe about the tariffs coming down substantially, but only for 90 days, I guess, underscores that gradual grind lower on the benchmark into the first 38 minutes of the session. So what do we make of this? How do you trade this? Wendy Chen, founder and CIO at Sigmoid Capital, a New York-based Pan-Asia long-short equity hedge fund, joins us right now to talk to students. Wendy, good morning from the Asia Pacific. Thank you so much for joining us. How do you trade this?
Yeah, no, I think right now the biggest two problems in the market are, one, the U.S. debt problem, and then two, the U.S.-China trade war problem. So when you look at the U.S. debt problem, the U.S. actually has experienced a very rapid physical expansion in the past 4 years. It went from 22 trillion government debt to about 36 trillion government debt in 4 years. And the 10-year Treasury interest rate went from 0% to 5% during that same period. As a result, the net interest expense the U.S. government is paying equals to about 5.7% of U.S. GDP now. A 5.7% of debt interest expense as a percent of GDP is not sustainable because the U.S. GDP does not grow, even 2% last year. So as a result, if the U.S. ever defaults on its debt, there will be a collapse of the U.S. dollar and a collapse of the bond and equity market. So there's a solution to this, in our view. One, the U.S. has to cut government spending. Two, the U.S. has to increase tax revenue. And three, the U.S. has to really cut interest rates. If they're able to do all three in a very balanced view, then they can have a beautiful deleverage. This is very hard to do standalone, and it's even harder to do if combined with a U.S.-China trade war. So we think because of the urgency to cut interest rates, the U.S. actually has incentive this time to negotiate a near-term trade deal with China. So that's kind of how we balance out the macro situation and pick stocks from there.
Wendy, it sounds like you're saying it's time to diversify away from the dollar and U.S. dollar assets. I'm just wondering, is that true? I mean, and for how long? Or is this something that you think is a short-term opportunity or something that's more structural?
We think it's more structural. So if you look at the past decade, long U.S. dollar-denominated assets unhedged has been the winning trade. And that's what a lot of people have put money for. 70 cents on dollar right now is in the U.S. assets. I'm not sure that's going to happen for the next 10 years. If we look forward for the next 10 years, we see a chance for a much weaker dollar because of the debt problem we just talked about. And a weaker dollar typically means weaker return for U.S. dollar-denominated assets. So we overall think that it's prime time to diversify away from U.S. dollar assets to EM assets. We see China as a very low correlation asset class to U.S. We see certain parts of Latin as low correlation to U.S. And we think in order to have a resilient portfolio for the next 10 years, one really need to have low correlation assets in the portfolio. And that's certainly not 70% in the U.S. assets. So it's prime time to diversify away from U.S. assets to EM assets.
Right, and there are several, to your point, there's several iterations of what that means, diversify away from the U.S. I think the one question I have is, what now, and we can talk about sort of like, the riskier strategies in riskier place, but what then becomes your safe haven? When it used to be dollar cash, what is that asset class now in times when things are uncertain, for example?
Yeah, so right now, certainly what we're seeing is gold price has really been bid up, and I think yen is also a safe haven. Usually people, when you have such a concentrated position and there's extreme crowding, extreme concentration in the U.S. assets right now, I think that's what a lot of investors really need to think about. Do they really need to have 70 cents on a dollar in the U.S. assets going forward? And is it long U.S. assets unhedged the right strategy? I think the safe haven changes from year to year. Right now, from our standpoint, any asset classes that's low correlation to the U.S. is good to have. China is an example. Certain parts of Europe is an example. Certain parts of high yield Latin American assets is an example as well.
You mentioned 70 cents to the dollar in U.S. assets now. How much does that have to come down? If I had to do, a mixture of something in terms of asset allocation, what's the appropriate amount of level of exposure should I have in the U.S. and in EM now?
So, EM's positioning has been really low in the past 10 years, and that was based on past performance and not, future performance. I think, if you look at, the outperformance of S&P versus China versus EM, that explains it. I don't know if there's a right number for the right percentage for each investor. I think that depends on each investor's risk appetite and their own ability to hedge U.S. dollar. I'm just generally thinking that if it's 70 cents on a dollar, if U.S. debt problem ever evolves into a default, that portfolio is not a resilient portfolio. So in order to have a more balanced, resilient portfolio, diversification is key. Now, you could diversify to 50-50, you could diversify to 30-70. It really depends on your risk appetite and your duration. So I think really it comes down to the core view that you just cannot have the same view that long U.S. assets unhedged is going to be the winning trade for the next 10 years.
Wendy, I'm looking at how you guys did this year. Very good January, not so good Feb, good March, not so good April. What do you own right now, and how do you see that strategy changing over the next few weeks or so?
Yeah, so I think this year, China has been very volatile. Overarching China strategy has been predicated on the theme that we think China needs to manufacture less and consume more. We see there is a room for U.S. and China to strike a balance, and the balance is for China to manufacture less and consume more. If you look at the GDP makeup for U.S. and China, consumption accounts for over 70% of U.S. GDP. And U.S. has very little manufacturing. China is the exact opposite. China actually has very little consumption, but manufacturing and property investment accounts for over 40% of its GDP. So as a result, China actually has overcapacity in certain pockets of its industry now, such as solar, such as EV materials, right? And China will have to actually go through a deep capacity over the next few years for these overcapacity industries. And that is deflationary. So in order to counter that, China will have to do more to support consumption. Net, that'll be good for both China and U.S., right? For U.S. to have more manufacturing and for China to have more consumption. So our China strategy overall right now is to be positioned for certain shorts in overcapacity industries in manufacturing sectors and to be long certain pockets of China consumers.
And China is your favorite market right now. Can you tell us a little bit more? How is positioning so far?
Yeah. So last year, Japan was our favorite market. And from Q3 2024, we've changed our view to move China to be our most favorite market. And that's for three reasons. One, the valuation is really cheap. MSCI China trades at about 12 times forward earnings versus Japan trades at 15 times and India trades at 23 times. Two, for positioning. China has become very low in positioning, especially within the global investor base. And three, for correlation. MSCI China's correlation with S&P is at its lowest in history. And that's a good thing because we want low correlation to U.S. assets. When we look at Japan, we still like Japan. I think the reflationary story is still continuing. But Japan's problem is that the reflationary theme is partly dependent on the Fed rate cut decision. And that reduces its correlation effects with the U.S. So we like China because it's a low valuation, low correlation, and low positioning. And right now, it counts for the biggest part of our portfolio.
Wendy, it's great to have you. Thank you so much for your insights there. Wendy Chen, founder and CIO at Sigmoid Capital, joining us live out of New York this evening. Coming up next, Asia set to bring in some of the toughest restrictions on TikTok, Instagram, and Snapchat as governments move to protect children from online harm. The latest on those crackdowns next. This is Bloomberg.
Right, welcome back to shows PG-13 coming up here, social media. So you have governments across the Asia-Pacific are leading this global charge to protect children from online harm, presenting this unprecedented challenge to the likes of TikTok and also Meta.
Yeah, for more, let's bring in our Bloomberg tech reporter, Newly Purnell. And Newly, just bring us up to speed here. What's really happening across these social media rules in Asia? Because it's not coming from D.C., it's not coming from Brussels.
Right. Well, that's one of the interesting things is you think about tech regulations coming from the U.S. or the EU or something. And in this case, starting really with Australia late last year, they passed this really bold, ambitious new rule to try to keep all kids under 16 off of social media, and they said it's not down to the parents or schools. The tech firms themselves have to ensure that they're not on there. Obviously, as you can imagine, tech firms were happy about that. And then we've seen increasing countries in this part of the world talking about doing similar things. Most recently, New Zealand just last year saying they're going to propose a similar bill. And then we've seen countries like Indonesia, Singapore talking about it, Malaysia, Pakistan, Vietnam, for varying reasons in some of those countries. But largely, we feel that the tech firms aren't doing enough to protect children. We're going to go ahead and say, you got to step up your game.
Okay, so what is the exposure then in terms of the business to tech giants? Why does it matter to them? And how do we need to be thinking about the business impact moving forward?
Right. You might think, well, look, they make all of their highest average revenue per users are usually in developed markets in the U.S. or Europe or something. But what's interesting about Asia-Pacific countries, particularly Southeast Asia and India, massive user base. I mean, 2 billion people in South Asia, 650 million plus in Southeast Asia. There are way more people on Facebook and Instagram in this part of the world than in the U.S., for example. So, and the demographics are young. They're sort of plateauing the usage of some of these services, particularly Meta, in the developed markets, but they're still really growing rapidly in this part of the world, particularly emerging markets. They test a lot of new features out here. This is where the future growth is going to come from. They're young users. They really need this part of the world going forward.
So what do we need to look for next? What are some things on the horizon now?
Well, when you talk to tech policy experts at some of these countries, some of these companies or other consultants, they talk about this term regulatory contagion. So the idea is, oh boy, it's like a virus. Australia's got it, and then it's going to spread to other countries. I would look for how Australia will implement the rule. So it's unclear how technically they will do it, how they're going to force the tech firms to do it, and then look at some of these rules are maybe still a few years out. The tech firms, for on their behalf, say, look, we've implemented new systems to try to use AI and other tech to really keep kids off. But I think it will be interesting to see how Australia makes this happen, and then to see if other countries around the world follow suit.
All right, thank you. Newly Purnell there, our Bloomberg tech reporter. Some other corporate headlines that we're tracking for you today. Nissan posts earnings later today with its financial crisis in danger of worsening. The car maker has already warned shareholders it faces a full-year net loss of more than $5 billion, just as U.S. tariffs cast a shadow over the global auto industry. NHK, meanwhile, is reporting that Nissan plans to double planned global job cuts to 20,000, and Kyoto says it's considering plant closures in Japan as sales tumble. President Trump says he spoke with Apple CEO Tim Cook just as the Wall Street Journal reported that Apple is considering hiking iPhone prices. Apple is reportedly exploring coupling price increases with new features and designs while avoiding the perception the hikes are tied to U.S. tariffs. Meanwhile, Bloomberg has learned Apple is planning a new AI management mode for a September iPhone software update aimed at prolonging battery life.
Right. Now, overnight, you have Coinbase surging and quite substantially here in late trade on news that it will be joining the benchmark S&P 500. Coinbase will replace Discover Financial Services before trading opens on May 19th. The S&P Dow Jones says that, the switch comes with existing member Capital One Financial set to acquire Discover. Right. Speaking of, just very, very quickly, FX markets, the big news is, of course, the big move up in the dollar and really how it's changed in terms of behavior given the risk on, risk off sort of dynamic out there. And what we're seeing today is really a stronger Chinese currency on the back of a stronger fixing coming through out of the PBOC.
And we are counting down the open of trade. Well, not really. We'll take a look at how things are looking at right now and the state of play in Hang Seng. And we are now at, the session low is 1.25% here, 2% downside for HS Tech as well. So there's certainly, the downside that we're seeing across Hong Kong markets, that is the exception here to the rest of the region. In fact, you see onshore still seeing some decent gains. The rest of the region also catching up to this massive announcement that we're hearing from the U.S. and China in Geneva, this de-escalation of tariffs and this 90-day cooling off period. And it seems like markets are sensing that relief here. And you take a look at what this whole trade truce is going to mean. We have a whole team to talk us through it from the economic perspective, also the markets perspective. Let's bring in Bloomberg Economics, Asia economist Chang Shu, also bring in our MLI strategist Mark Cranfield with more on this. Chang Shu, I'll start with you. How should we view this deal?
It's very positive, certainly for the short term. I would say it's an unmitigated positive spur for short-term growth. In terms of the longer term, the signs are still positive, but of course you will have to look at the final deal and how China is going to continue its effort to rebalance the economy. So if we go back to the short term, we know recently there have been signs of China's shipment to the U.S. collapsing, and that's spreading to the rest of the economy if we look at the PMI. So this truce would mean the exports will restart again, potentially front-loading, kind of spurring growth in the near term. But medium term, we do need to look at a wider sort of deal and how China takes its action.
Yeah, you mentioned about the front loading. What should we expect in the next 90 days then? I mean, is that enough time to really come up with some sort of complex long-term deal?
It is very complex, and certainly there will be challenges on the way. At this point, we feel positive that a final deal can be reached. If you look at the agreement coming out of the two sides in Geneva, the tone is very constructive. And if you watch the press conferences by the two teams, you can see the tone is positive and the body languages are very positive, and both sides showing respect for each other. So given those signs, we feel, we can get something lasting. But the final tariff rate, we kind of think possibly it will be more or less what it looks like now, although the composition might change slightly. For example, the functional related 20% might go, but ultimately the reciprocal tariffs could be higher.
Mark, chime in on the market perspective here, because what we saw yesterday was quite remarkable, right? Dollars back up, treasury yields shooting higher, havens are selling off. This whole sell America sort of wave seems to be subsiding a little bit. How long can that last?
Well, as long as we don't go back into the tit-for-tat negativity that we were seeing between the China and the United States about a month ago, then it can go quite a long way. Although this term of Buy America is probably a bit exaggerated, because obviously treasuries are not participating in that. Certainly the US dollar is doing well, and equities especially are doing extremely well. But we're not seeing people jump back into the treasury market because it's giving the Federal Reserve a reason to stay on hold for much longer. But from a sentiment-driven point of view, what investors were most concerned about was that once we entered that negative spiral where we were hearing day after day the United States wanting to put on more tariffs to cause more disruption to financial markets, and then other countries, including China, responding with their own stance as well. It just looked as though we were going into an endless spiral of where there was no good news. People just wanted to weaken markets, and it was just looking especially ugly. What investors are now hoping is that's behind us, and that from here, when we do hear sound bites, they're mostly going to be skewed in the positive direction. I mean, that was the clear messaging that came out over the weekend. It was almost a coordinated way to make markets feel better, both from the US side and the Chinese side. Everything that came out of the talks in Geneva was designed to lift the mood in financial markets. And as long as that kind of perspective is retained, then you will see investors continue to put money to work, especially in equity markets, which obviously now they're going to play a big catch-up, because what we've seen is a period where they were under a cloud for several weeks. During that time, Companies weren't sure which direction they were supposed to go, but now the outlook is looking a lot better, and there could be a big catch-up play across the board in equity markets.
And we're seeing a 718 handle for dollar offshore China, Mark. You mentioned in the MLive blog about that fix, which we haven't seen below 720 for 5 weeks or so now. What does that tell you? How big of an anchor is this strong renminbi against, we take a look at how Asian currencies are going to go?
It's very encouraging for Asian currencies in general. It looks as though the PBOC is pulling back slightly. They're not saying go gangbusters. And there's not a completely clear path for the Chinese currency, but what they are saying is they're not quite so concerned that they need to use the yuan as a bargaining chip in the trade talks. They can be a little bit more flexible now, so they can give way to some of the market. The market was beginning to push for a slightly stronger yuan anyway, but we were seeing through the use of the fixings that they were prepared to keep it a bit higher. That's why it was above 720 on the daily fix for several days in a row. But now they're easing back slightly. Yesterday, Goldman Sachs had a report saying they see dollar yuan going to about 7 in the months ahead. Well, that's probably the kind of level where the PBOC would be comfortable with, providing it goes there in a gradual manner. The PBOC is never keen to see the FX market go fast in either direction, whether it's up or down. As long as it's relatively gradual, it would take other Asian currencies with it, and we may head towards that kind of threshold. But at any time, we'll be watching to see what the central bank does, because we've seen them before. They can pivot very quickly. If they decide that the mood swings are not going as well as they expected, you will see them go back and move the fixing higher. If not, they will allow the market to push it slightly lower, and they will respond with fixings in tune with the direction the market is taking them.
Mark, thank you, Mark Cranfield, there, MLive strategist. Also, our thanks to Cheng Xu, Chief Asia Economist at Bloomberg Economics. And we're bringing you back to those live pictures out of Beijing. The China CELAC summit is underway in the capital. And there you go. You see President Xi stepping up to the platform here right now. And we're really talking about what to expect in this summit between Latin American countries. We talked about President Lula from Brazil looking to ink some trade deals. Let's listen in.
Lula da Silva. Your Excellency, President Gabriel Boric. Your Excellency, President Dilma Rousseff. Delegates of CELAC member states. Ladies and gentlemen, friends. It gives me great pleasure to meet so many old and new friends from Latin American and Caribbean countries in Beijing. On behalf of the Chinese government and people, I extend a warm welcome to you all. In 2015, LAC delegates and I attended the opening ceremony of the first ministerial meeting of the China CELAC Forum in Beijing, which marked the launch of the China CELAC Forum. 10 years on, with dedicated nurturing of both sides, the forum has grown from a tender sapling into a towering tree. This fills me with deep pride and satisfaction. Although China and LAC region are geographically distant, the bonds of our friendship stretch back through centuries. As early as in the 16th century, Nao de China, or ships of China, laden with friendship, shuttled across the Pacific, marking the dawn of interactions and exchanges between China and the LAC region. From the 1960s onward, as New China established diplomatic ties with some LAC countries, exchanges and cooperation between the two sides became closer and closer. Since the turn of the century, and in particular in recent years, China and LAC countries have ushered in a historic era of building a shared future. we stand shoulder to shoulder and support each other. China appreciates the long-standing commitment of LAC countries that have diplomatic ties with China to the One China principle. China firmly supports LAC countries in pursuing development paths suited to their national conditions, safeguarding sovereignty and independence, and opposing external interference. In the 1960s, mass rallies and demonstrations took place across China in support of the Panamanian people's rightful claim to sovereignty over the Panama Canal. In the 1970s, during the Latin American campaign for 200 nautical mile maritime rights, China voiced its resolute and unequivocal support for the legitimate demands of developing countries. For 32 consecutive times since 1992, China has consistently voted for the UN General Assembly resolutions calling for an end to the US embargo against Cuba. We ride the tide of progress together to pursue win-win cooperation. Embracing the trend of economic globalization, China and LAC countries have deepened cooperation in trade, investment, finance, science and technology, infrastructure, and many other fields. Under the framework of high-quality Belt and Road cooperation, the two sides have implemented more than 200 infrastructure projects, creating over 1 million jobs. The China-LAC Satellite Cooperation Program has set a model for high-tech South-South cooperation. The inauguration of Shanghai Port in Peru has established a new land and sea connectivity link between Asia and Latin America. China has signed free trade agreements with Chile, Peru, Costa Rica, Ecuador, and Nicaragua. Last year, trade between China and LAC countries exceeded $500 billion for the first time, an increase of over 40 times from the beginning of this century. We unite in tough times to conquer challenges through mutual support. China and the LAC countries have collaborated on disaster prevention, mitigation and relief, and on joint response to hurricanes, earthquakes, and other natural disasters. Since 1993, China has dispatched 38 medical teams to the Caribbean. When the pandemic of the century struck, China was among the first to offer assistance to LAC countries, providing over 300 million doses of vaccines and nearly 40 million units of medical supplies and equipment, and sending multiple teams of medical experts. All this helped protect the lives of hundreds and millions across the region. We uphold solidarity and coordination and rise to global challenges with resolve. Together, China and LAC countries champion true multilateralism, uphold international fairness and justice, advance global governance reform, and promote multipolarization of the world, greater democracy and international relations.
President Xi Jinping there speaking in Beijing at the China CELAC summit and really talking about the solidarity, this embracing of globalization between China and these LATAM countries, and certainly one to watch on what sort of trade deals could come out of this summit. We already talked about President Lula there trying to ink some of these trade deals with China, whether it is on the agricultural side, also expanding this sort of Chinese investment into infrastructure and the like here in some of these projects. And, Xi also lauding and talking about the amount of jobs that have been created in the face of these sort of infrastructure projects, 1 million jobs he talked about there. So certainly one to watch in the face of this whole trade war that we're seeing between U.S. and China. And it seems to see that Brazil is one of those countries that looks to benefit and deepen their ties with Beijing. So that's one to watch. We'll hold that there. We'll bring you those live pictures once we see any sort of news that comes out of there. Live Go is where you can continue watching this speech. You'll also find the big diary entries coming up today, later on this week, as well as some of the events you may have missed earlier. We got plenty more ahead. This is Bloomberg. All right, taking you back to live pictures out in Beijing, and you're hearing President Xi now talking a little bit more about maybe not just what we're seeing in the CELAC forum, but also in general, no winners in the tariff war and trade war. That's the latest line coming through from the president. This is, of course, on the back of what we heard, this massive de-escalation of trade tariffs from the U.S. and China. Let's listen in.
The first is Solidarity Program. China will work with LAC countries to support each other on issues bearing on our respective core interests and major concerns. We must enhance exchanges in all fields and strengthen communication and coordination on major international and regional issues. In the next 3 years, to facilitate our exchanges on national governance best practices, China will invite 300 members from political parties of CELAC member states every year to visit China. China supports the efforts by LAC countries in increasing their influence on the multilateral stage. We will work with LAC countries to firmly safeguard the international system with the United Nations at its core and the international order underpinned by international law, and to speak with one voice in international and regional affairs. The second is Development Program. China will work with LAC countries to implement the Global Development Initiative. We will resolutely uphold the multilateral trading system, ensure stable, unimpeded global industrial and supply chains.
Yep, there we go. The Chinese president giving the speech, of course, and a lot of lines coming through, and certainly the context here is extremely important. And the timing perhaps couldn't be better, given this 90-day, let's call it truce, on the trade war front, and tariffs on both sides, from both sides, materially coming down for 90 days. And I think some context really coming through here out of the Chinese president, speaking clearly against bullying and hegemony. Those two things, he says, leading simply to isolation at this point in time. Again, to recap some of the lines coming through as well, there are no winners in a tariff war and a trade war. Okay, let's just peel away just ever so slightly out of the geopolitical context and have a look at what's taking place in Manila. Of course, midterm elections on Monday, and we are getting a better indication of how results have been coming through there out of Manila. Markets are up. We're looking at, we're up, give or take, about 2.5%. That's over 2 days right now. Let's get a sense of what the key takeaways are. We're joined by Bob Herrera-Lim, Managing Director at risk consultancy Teneo, to take us through this. Bob, good morning, and sorry to keep you waiting, of course. We did have some breaking news there. Why should we I'm trying to phrase this in a very polite way. Why should we care about this from a sort of global perspective? Just give us the foreign policy implications first.
Yeah, well, as you might know, what is coming out as a narrative from Manila is that the Marcos administration did not do well in the elections. Several of their candidates lost. It was much, much lower than what everyone was expecting. So I think what happens from this is Marcos has to recalibrate some of his policies. He has to start thinking, is it worth picking a fight with Duterte, and how badly should that fight be? And second is, should he start walking back, or at least recalibrating the sort of strident or very aggressive anti-China policy, and sort of try to find some kind of middle ground with China on the South China Sea? Because obviously there's been a rebuke of his government. It's not clear whether that rebuke is based on the China policy, on his Duterte policy, but at least it might give the government some pause and start thinking they have to focus on governance, they have to focus on stability, and some of the things that might have fallen into the wayside in the fight between the Marcos and Duterte families.
And it certainly has shown this Marcos and Duterte alliance has really deteriorated. What does it tell you about their political futures, especially when it comes to the Vice President Duterte and the chances of surviving this impeachment trial?
The mood in the Philippines is palpable right now that Sara Duterte will not be impeached. It has increased her chances that she will not be found guilty by the Senate, and that therefore she remains a viable candidate for the 2028 presidential elections. But the other thing is, two candidates who are expected to perform not as well, Bam Aquino and Kiko Pangilinan, surged into the top 6. And this is sort of the middle centrist force that was aligned with Vice President Leonor Robredo in 2022. So it's almost like they sneaked in, showed that they still have a strong base, that they've been able to maintain the constituency that supported the anti-Marcos, anti-Duterte vote in 2022. So that's something else the political players in Manila have to figure it out. And that's a good thing, because then you have a third force, and it's not simply about Marcos versus Duterte in terms of politics going forward.
Yeah, I mean, that was surprising, Bob. I have to say, statistically going into this, the polls were showing Bam and Kiko almost just barely making it, if not there. And, we were having a conversation here right before the show started. How do we characterize this? This is a third camp, almost a pre-administration camp as well. So we have three camps, as you point out. So paint us a picture. 2028 elections, two things here. What does this mean for the relationship between Marcos and Duterte? Is there a way back, you think, between the two for them to figure things out? Or do they remain opponents, political opponents going into 2028? And what about the other factors as well going into that next presidential election?
Yeah, my expectation is bridges have been burned between the Marcos and Duterte camps, especially with the way the former president was sent to The Hague for trial and everything. I think that just simply created a lot of bad blood that it's difficult for them to walk back on that event. Now, insofar as a third camp is coming in, it will pull politics to the center, right? Because it will show that politics in Manila is no longer right now just about will Marcos get his way for 2028, or will the Dutertes emerge as the overwhelming favorite? They have to now start thinking of that middle vote, which could be anywhere from like 25 to 35% of the electorate. And if you neglect that, then you lose that electorate, and somebody might just come in and steal it. So I think that's really the sort of tone that it sets for 2028, that you now have three forces, one of them in the middle, what you might call centrist right now, aligned with the traditional elites, and that's something the Marcos and Duterte camps have to figure out.
Bob, great to have you. Bob Herrera-Lim there, Managing Director at Teneo. We'll bring you back to those live pictures out of Beijing, and President Xi is speaking at the summit between China and the LATAM countries. And some interesting take here when it comes to what we're hearing in terms of the trade war. He says bullying and hegemony only lead to isolation. There are no winners in a tariff war and a trade war. So also China, who has been defiant in this whole trade war with the U.S. up until now, also softening their stance and pulling back a little bit as, of course, we continue and start this 90-day cooling period between the U.S. and China.
Yeah, in fact, just on that very note, maybe separately, UBS Wang just coming out with a note here that GDP growth in 2025 may improve. That's a line that's come through it as well. And just to attach a number to what Yvonne was pointing out here, China will be offering 66 billion yuan credit line support to LAC countries, according to the Chinese president, still speaking, as you can see live out of Beijing. This is The China Show. We'll see you all tomorrow.